Everyone's been staring at the loudest market in the room, silver, gold, crypto, the AI everything trade, because that's where the headlines live. But while attention was glued to the shiny stuff, a quieter market started screaming Japan's government bond market. And if you understand what Japan represents in global finance, you'll understand why this matters more than any single commodity squeeze. Japan isn't just another country with a bond market. Japan has been the foundational funding source for the entire modern era of leverage. For decades, Japan was the world's cheap money socket. You plugged into yen funding at near zero rates, you converted it into dollars, euros, pounds, whatever, and you bought anything that moved: tech stocks, private credit, emerging market bonds, real estate, venture capital, even Bitcoin. That trade became so normal it stopped feeling like a trade. It started feeling like gravity. Now look at what's happening on the long end of Japan's yield curve. Not the 2-year, not the 5-year, the part of the curve that screams confidence or panic, the 20-year, 30-year, 40-year. When the 40-year yield pushes above 4%, that is an acute number. In Japan, that's a regime change. That's the end of the post-bubble era playbook. That's the market telling the Bank of Japan, we don't believe your old rules apply. And before someone in the US says, so what? Our yields are higher. Remember the context: Japan built an entire fiscal universe on the assumption that rates would stay pinned near zero forever. Japan has debt to GDP around the 250-260% range, depending on the measure. They can survive that only if interest costs stay anesthetized. A small move up in yield is not a little tighter financial conditions. It's the difference between a manageable budget and a math problem with no political solution. This is why Japan's bond market has a nickname in macro circles, the Widowmaker. Not because it's exciting, but because it buries people who underestimate it. So what changed? Two forces collided. First, inflation and wage pressures, even if modest by Western standards, started to matter in Japan. Second, the yen weakened hard enough that it stopped being a chart and started being a national security issue. Because Japan imports energy, imports food inputs, imports industrial materials. A weak currency is a direct hit to living standards. So the BOJ gets cornered. If they keep buying bonds aggressively to cap yields, the yen can weaken more. If they stop capping yields to support the currency, bond prices fall and yields spike. You can't protect everything. And that's the key theme of this entire story. The world is entering a phase where central banks can't simultaneously defend bond prices, currencies, and growth. Something has to break first. Japan may be the first major system where the break is visible in the long bond. If you want the simplest mental model, use this: Japan is not a local market. Japan is plumbing. And when plumbing cracks, the leak shows up everywhere. US mortgage rates, equity valuations, corporate borrowing costs, emerging market funding, even the liquidity behind your safety, money market funds. So the real question is not, will Japan have a bad year? The real question is, what happens to the world when the cheapest funding source on Earth becomes expensive and the biggest overseas investor on Earth starts pulling capital home? To understand the next domino, you need to understand what Japan has been doing for years with its national savings. Japanese households saved. Japanese institutions accumulated enormous pools of capital, pension funds, life insurers, banks, trust accounts. But at home, yields were dead, so they went abroad. They bought US Treasuries. They bought European sovereign debt. They bought investment-grade credit. They bought US equities, especially the most liquid, most scalable, most index-heavy names on the planet. Japan became one of the most important external pillars under US asset prices. Now flip the incentives. If you can earn materially higher yields at home, in your own currency, without FX hedging costs, without praying the dollar doesn't move against you, then suddenly foreign assets are no longer the obvious choice. This is where repatriation stops being a buzzword and starts being a flow, because it's not just that Japanese investors might prefer domestic bonds, it's that they may need domestic liquidity. When yields rise, bond prices fall. If you're a Japanese insurer or pension fund holding large JGB portfolios, your safe assets can generate mark-to-market losses. That doesn't mean Japan instantly goes bankrupt tomorrow morning, but it does mean balance sheets tighten, risk budgets shrink, and portfolio managers get forced into decisions they don't want to make. And forced decisions create forced selling. There's been growing market chatter around potential trimming of US equity exposure by Japanese institutions. Figures like hundreds of billions get thrown around, sometimes around the 500B range, depending on what's counted and over what time frame. Whether the number ends up smaller or larger is less important than the mechanism. If a big pool must raise yen liquidity, and their most liquid profits are overseas, they sell overseas. And what are the most liquid overseas profits? The same stuff sitting in everyone's retirement accounts. Mega cap US tech, broad index exposure, the winners of the last decade. Here's the part retail investors often miss: large institutions don't sell like you sell. They don't wake up, panic, smash, market sell, and go back to bed. They sell like a glacier moves, slow, heavy, relentless. They use rallies to exit. They sell into strength. They rebalance. They run programs. That kind of selling is worse than a one-day crash because it changes the texture of the market. You get this pattern: down 2%, up 1%, down 2%, up 1%. Everyone feels the bottom is close. But the overhead supply never leaves. It's not fear-based selling. It's mandate-based selling, and mandates don't get comforted by a CNBC segment. Now add the currency layer. When Japanese institutions sell US stocks or bonds, they receive dollars. If they're repatriating, they convert those dollars back into yen. That is a flow that strengthens the yen. And a strengthening yen is not just a currency story. A strengthening yen is a wrecking ball to the carry trade, the trade that funded a huge portion of global risk-taking. So you get a potential feedback loop. Japan sells overseas assets, debuys yen rises, carry trade breaks, leverage funds sell risk assets fall to volatility spikes, more forced selling. You don't need apocalypse language to understand this. It's just leverage math. And if you want the clean takeaway, the world has spent years building portfolios under the assumption that Japan would always be a net exporter of capital. If Japan becomes a net importer of capital, the river reverses. And when the river reverses, the boats that relied on that current start drifting into rocks. That brings us to the carry trade itself. Let's talk about the trade that quietly powered the everything rally. The yen carry trade. In plain English, borrow in yen at very low interest rates. Convert the yen into another currency. Buy higher, yielding or higher, growth assets elsewhere. Pocket the spread, and repeat. This isn't a niche strategy. It's embedded in global finance. Hedge funds do it. Banks do versions of it. Asset managers do it. Corporations indirectly do it. Even if someone isn't explicitly short yen, they may be positioned in a way that depends on yen staying cheap and stable. The carry trade works best when three conditions hold: funding is cheap. Volatility is low. The funding currency doesn't strengthen against you. If the yen strengthens while you're short yen, you're not just paying interest, you're bleeding FX losses. And those losses can trigger margin calls. Margin calls are where macro narratives turn into real-time liquidation. Because the cure for a margin call is always the same: sell what you can fast. And what can you sell fast? The most liquid, most crowded, most universally owned assets on Earth: US index futures, mega cap tech, high beta equities, credit ETFs, and yes, crypto. That's why in the early stages of deleveraging events, weird things happen. The thing you thought was digital gold trades like a leveraged NASDAQ position. The thing you thought was safe cash suddenly has spread issues. The thing you thought was diversification becomes correlation. This is not because the long-term story is dead. It's because leverage unwinds first and fundamentals get to speak later. Now here's the deeper problem. The yen carry trade isn't only about hedge funds. It's about the global price of money. When Japanese yields rise, the global risk-free competitor changes. Global investors reprice duration, they reprice term premium, they reprice the value of long-dated cash flows. And what is most sensitive to long-dated cash flows? High-duration assets, growth stocks, venture like equities, long-dated credit, speculative tech, anything priced on years from now. So even without a dramatic crash, you can get a grinding re-rating. Not a cinematic 1987-style air pocket, more like a long corridor where valuations keep getting squeezed, rallies keep failing, and investors keep asking, why does every bounce feel heavy? Because the market is digesting a new cost of capital. And the cost of capital is not just the Fed funds rate. It's global. Japan matters because Japan has been a structural suppressor of yields and a structural supplier of liquidity. If that liquidity gets pulled home, global markets don't just lose a buyer, they lose a funding model. Now, if this were only about equities, it would already be big. But the real epicenter, the place where everything connects, is the US Treasury market. And that's where this story becomes not just portfolio volatility, but system stability. The US Treasury market is the foundation beneath almost everything. It's the benchmark for mortgage rates. It's the benchmark for corporate borrowing. It's the collateral behind leverage. It's the reference point for risk pricing. And for a long time, a major piece of demand for treasuries came from outside the US, including Japan. Japan has been among the largest foreign holders of US treasuries for years, often around the $1 trillion neighborhood, depending on timing and reporting. That doesn't mean Japan alone controls US yields, but it does mean Japan is one of the critical marginal players in a market where marginal flows matter. Now combine two realities. Reality fee winters the US runs very large deficits and continually issues new debt. Reality E2E foreign official demand has at times been less reliable than in past decades. So if a major holder slows purchases or starts selling to raise yen liquidity, treasuries must find a new buyer. Who? Domestic private buyers can absorb some. Banks can absorb some until balance sheets get constrained. Funds can absorb some until yields rise enough to break something else. And then there's the buyer that can always buy, the Federal Reserve. This is where people get emotional and start yelling, hyperinflation tomorrow. Let's be precise. The Fed doesn't print because it enjoys it. The Fed prints when the system forces it. If treasury auctions get disorderly, if yields spike too fast, if funding markets seize, the Fed steps in, not as a political choice, but as a stability mechanism. They can call it whatever they want: liquidity operations, market functioning support, temporary purchases, a new facility, yield management. But the outcome is similar. Central bank balance sheet expands to prevent a funding crisis. Here's the trap: if the Fed intervenes aggressively to cap yields, that can weaken the dollar and raise inflation expectations. If the Fed does nothing and yields rise violently, financial conditions tighten and the economy can crack. So policymakers end up choosing between two painful outcomes: A, let rates rise and accept recession deleveraging; B, cap rates and accept currency debasement, asset inflation. Historically, in debt-heavy systems, policymakers lean toward option B, especially when unemployment, elections, and fiscal realities collide. This is why Japan's shift matters beyond Japan, because it increases the odds that the US eventually has to choose between high yields that break the economy or intervention that erodes purchasing power. And once the market believes intervention is coming, the market starts front-running it, not with polite academic positioning, with aggressive rotation, out of long-duration paper promises, into assets that don't require someone else's ability to pay. That's where hard assets enter the story, not as a meme, but as a balance sheet response. And yes, precious metals are part of that, but the key is to understand the sequence. First comes the liquidity shock, then comes the policy response, then comes the inflation, real asset repricing. If you get the sequence wrong, you get whipsawed. So now let's talk about what tends to get hit first, what tends to hold up, and where the hidden fragilities live, including places people mistake for cash. If global liquidity tightens because Japan repatriates and leverage unwinds, the first casualties are usually the most crowded and the most liquid risk assets. That often means mega cap growth and index heavy equities, not because the companies are bad, but because liquidity lives there. Institutions sell what they can sell. High yield credit and private credit sentiment. When refinancing costs rise, the weakest balance sheets become obvious. Crypto in the early phase, not as a statement about long-term viability, just mechanics. In a margin call environment, crypto often trades like leveraged risk. It can drop sharply even if the long-term thesis is hard money. It's hash-like. Products that aren't truly cash, this is where people get uncomfortable. Money market funds are designed to be stable, and they're regulated, and they generally behave, but generally is not guaranteed. They hold short-term government paper and other instruments that depend on functioning markets. In stress, the issue is not always default. It can be liquidity, spreads, and forced selling. I'm not saying your money market fund is about to implode tomorrow. I'm saying too many people treat anything with the word money in it like it's a vault. In market stress, the only thing that is truly cash is cash at a solvent institution with immediate access, or direct short-term bills held to maturity depending on structure and custody. Now, while risk assets can get hit first, something else can happen at the same time. Hard assets can start acting differently. Energy can catch bids on supply risk. Industrial metals can catch bids on restocking and infrastructure. Gold can catch bids as confidence in real yields and currency stability gets questioned. Silver is the wild card because it sits in two worlds, industrial demand and monetary demand. In a pure liquidity crunch, silver can initially dip with risk because it's traded and it's liquid. But if the policy response is aggressive, rate caps, renewed balance sheet expansion, fiscal dominance, silver can move violently because the market is smaller than gold and more sensitive to incremental flows. That's why silver can be boring for years and then become chaotic in months. Now zoom out. If Japan's shift leads to a multi-quarter grind, programmatic selling, higher global term premium, repeated volatility spikes, then buy the dip forever becomes less reliable. The game changes from maximum exposure, minimal hedging, to risk management, liquidity awareness, real return focus. So what do you actually do with that? Not as a prediction that the world ends, not as financial advice. As a framework, you build a portfolio that can survive higher volatility, higher financing costs, policy interventions, and a weaker long-term purchasing power trend. That portfolio is not one magic asset. It's a structure. And that brings us to the practical positioning framework. Here's the reality: the old default portfolio assumptions are under pressure. The classic stocks up, bonds down, stocks down, bonds up relationship can fail when inflation risk and sovereign financing risk rise together. In those windows, correlation can spike and diversification can feel fake. So the goal is not to predict one perfect outcome. The goal is to avoid being structurally fragile. Think in layers. Layer 1T. Liquidity you can access without selling at the worst moment. This might be true cash buffers, short duration instruments you understand, and avoiding hidden leverage. Layer 2N. Assets with pricing power or scarcity characteristics. This is where commodities, energy exposure, and real assets enter, depending on your risk tolerance and time horizon. Layer 3N. Monetary hedges. Gold historically plays the role of confidence hedge. Silver can be the higher volatility cousin. More industrial sensitivity, more upside potential if monetary demand shows up, but more drawdown risk during liquidity shocks. Layer 40. Equity exposure that isn't purely long-duration fantasy cash flows. If rates stay higher, the market tends to reward cash generation, reasonable valuations, and balance sheet strength more than maybe profits in 2032. Now, the most important thing to understand about a Japan-driven unwind is this: it can be slow. Markets don't always collapse in one day. Sometimes they bleed through repeated squeezes and failed rallies. That's psychologically brutal because it trains people to keep averaging down into a structural seller. So if repatriation flows do accelerate, you may see a market that feels like this: rallies that don't follow through, volatility spikes that reset positioning, headlines that alternate between crisis and crisis averted, and steady pressure on long-duration valuations. In that environment, the winners are not necessarily the people with the loudest conviction. They're the people with staying power. And staying power comes from not being forced to sell. That's the entire theme of this event: forced selling. If Japan is forced to reallocate because domestic bonds reprice, they sell what they can. If leveraged funds are forced to cover yen exposure, they sell what they can. If treasury yields spike and something breaks, policymakers respond, and the currency absorbs part of the shock. So you position around one question: what do I own that could force me to sell at the worst time? High leverage, illiquid private deals, over-concentrated single stock exposure, duration, heavy bond portfolios, anything dependent on stable funding markets. This isn't about fear, it's about construction. And now we end where we started: why Japan is not just Japan, and what to watch next so you're not trading headlines. So here's the full picture cleanly. Japan's long end yields rising is not just a Japanese story. It's the potential end of an era where Japan exported capital and suppressed global funding costs. If yields at home become competitive, capital has a reason to come back. If capital comes back, foreign assets can face persistent selling pressure. If the yen strengthens, carry trades unwind. If carry trades unwind, leveraged risk assets get sold. If U.S. Treasuries face weaker foreign demand while deficits remain large, yields can rise, or the Fed can step in. If the Fed steps in aggressively, purchasing power becomes the pressure valve. That is the chain. Now, what do you watch to know if this is intensifying? The yen trend and volatility, not just direction, volatility. Funding trades hate volatility. Japanese yield curve behavior, especially the long end. Disorderly moves matter more than level. U.S. Treasury auction strength and bid to cover metrics. Weak auctions are the smell of stress. Cross-currency basis and FX hedging costs. When hedging costs change, the incentive to own foreign bonds changes. Equity market, failed rallies, heavy tape, repeated sell into strength behavior can signal structural distribution. And finally, don't confuse a temporary calm with resolution. Systems don't always break with a headline. Sometimes they break with a slow shift in incentives, until one day, the market realizes the old buyers are gone. This is why the Japan story is so important. It's about the buyer becoming less of a buyer. And in markets, the marginal buyer sets the price. If you take one lesson from this entire breakdown, take this in the next regime: the most valuable asset is not the asset with the best story. It's the asset that lets you survive volatility without becoming a forced seller. Build for resilience first, then hunt for upside. Because if Japan really is pulling liquidity home, the world won't reprice in a single candle. It will reprice in waves. And you'll either be positioned before the waves hit, or you'll be trying to swim after the current already turned.